Under Armour shirts now?
I did not. You know what?
Did you sew the logo on? Is it some bootleg shit?
I didn't tailor this. I just fit into this naturally. But that's true. Under Armour already makes stuff tight enough that I don't need to tailor it.
Nice.
Regardless.
Do you really put your clothes in the dryer before you wear them in the morning to get them extra tight? Nice.
Sometimes I do. Yeah. Please don't cut that out, Jesse. Welcome to episode 22 of the More Doors podcast. I am super excited for today's show and today's guest. He's got a hell of a story and he's making a hell of an impact with what he's doing now. We're going to get started right now. Here we go. Welcome back. Episode 22. I just have to ask you, so I stop it down. So when do you start listening to Christmas music? Because
typically the day after Thanksgiving, but it's like next week. So
it's close enough.
I hear Mariah's been ready since like before people put the ghost costumes away last month.
Yeah, midnight on Halloween.
Yeah, she was all dressed and ready to go, ready to lip sync her way through Christmas.
But you don't share that opinion with anybody is what I like, because people...
I think I just did.
No, but I asked you. I just don't like people that are like, you listen to Christmas music before Thanksgiving.
I know. Like, don't be so stuck up.
Yeah, get out of here, bro. Have some Christmas.
I'm going to do Jingle Balls all year.
I'll listen to it in August.
Let's go.
Leave me alone. Welcome back. Episode 22. We have got an incredible guest today. We're super excited to talk with Yannik Cudjoe-Virgil and have him share his story, his journey, everything that he's doing right now. You're going to want to listen to this one. But before we dive in, make sure you go check out deepbluere.com, the home of Deep Blue Capital. If you want to build your passive income, your legacy wealth, make your financial dreams come true, check out Deep Blue RE and what we've got going on there. We're looking at more deals, submitting LOIs. We've got a lot going on. Buyer activity is picking up, and we'd like to partner with you to help you achieve your financial dreams. And then after that, go ahead on over to Tor Studios, TORE Studios.com. If you want to set up a kick butt podcast like we've got going on right here in this incredible studio, Jesse Showalter at Tor Studios will hook you up. So check out TORE Studios.com. I don't think we should give Nick his job back.
I don't think so.
I'm pretty good at
this.
I think
we flow. Yeah, I think this is good.
I don't want to be.
Maybe one day I can stop sitting at the kids' table and do an intro.
I know. I ask you every time if you want to, and you keep deferring.
Yeah, but I don't think you realize that you ask in a way that insinuate that you still want to do it.
Oh, okay. Well, maybe I don't have that much self-awareness. Regardless.
Like, do you want to do it?
Like already downward inflection.
Exactly.
Oh, my gosh. Well, why don't I do this? Why don't you introduce our special guest today, which I'm very excited about, Mr. Oh, I'm already doing it. So now we're going to ease in.
All right.
Just put a toe in the pool.
Here I go. I'm getting put on the spot. All right. So today's guest, hailing from the great state of Maryland, is Yannik Cudjoe-Virgil with Merlin Real Estate Partners. Yannik, welcome to the show.
Thanks so much for having me. I appreciate it.
Yeah, absolutely. So Yannik is ready to go.
Yeah.
We did a little chat before the show. Amazing story, and rather have me tell it and butcher it, let's have the man himself chime in. Yannik, tell us a little bit about yourself and where you're coming from.
Oh, thanks so much. So again, my name is Yannik Cudjoe-Virgil. I'm the managing principal for Merlin Real Estate Partners. We primarily focus on acquisition and development of affordable housing. On the development side, we're moving into LIHTC strategies, LIHTC acquisition and development. But my story is a little bit different. Prior to real estate, I had the opportunity to play in the NFL, which was a fantastic opportunity because I was able to live out my dream, right? I walked on Division I, wasn't the guy that anyone looked at, ended up being one of the top linebackers in the nation. Then I had the opportunity to, move into the NFL, right? Which, less than 1% makes it. So unfortunately, I had a career-ending knee injury my rookie year, tried to bounce back. It did not work out, so had to transition into the world of real estate. And I really didn't know anything about real estate. I remember meeting a developer in Nashville, and he showed me commercial real estate and why that was a fantastic opportunity to invest in. And I just kind of fell in love with it. And I didn't have any background when it came to, finance or anything with an MBA. So I decided to, hustle and use some of the same traits that got me to the NFL in real estate. So I started networking, trying to find different firms and entrepreneurial firms and founders that would be able to take a chance on me. Ended up finding one and, off to the races, worked for a couple of private equity firms for about, a span of 4 years, particularly in the world of asset management. So that really allowed me to see the acquisition and the operations piece, hands-on, leveraging, institutional and retail knowledge when it came to the capital source that was being deployed on these assets. And then, I've been full-time for about a year and a half after that span. So, right now, again, we're focused on acquisition and development of affordable housing. And, we're super excited for the future.
Nice. So there's just so much to unpack there. I definitely want to talk about, the football career and how you got there and a little bit about kind of your journey since, an early departure from the NFL due to your knee injury and then the PE. And then you're the first guest we've had to talk about affordable housing on the show. So, definitely kind of an untapped conversation there. And quite frankly, there's nothing more important and then solving that in this country, I think, right? Everybody talks about the A-class complexes with the pools and the pet spas and all kinds of stuff because it's glamorous, but there's a whole segment of the market that's being underserved right now because there's not enough affordable housing. So I appreciate what you're doing and definitely want to come back to that. So let's start with the NFL first, if you don't mind. So before the show, we were talking and you just mentioned that you had a kind of an early into your career because of an injury. Sorry, too much caffeine.
Not live.
Yeah. So, tell us a little bit about that and kind of what you went through mentally in order to be able to rebound from that and land on your feet in something as promising as with what you're doing.
Yeah. So I tore my patella tendon, which is the tendon right in front of your knee. If you touch your knee right now as a listener, that tendon that's in front of your knee, essentially I tore that in the middle. And it's probably one of the more challenging injuries to bounce back from because, from an injury perspective, tendons are the worst. Then there's the ligaments and then there's bones, right? It was very, very challenging because of the pressures that is involved in professional sports, particularly in the NFL, because it's such a revolving door. I mean, I remember coming into my rookie year and, guys were, think about this, right? I tell people this all the time, like every Tuesday in the NFL is a day off, right? And typically you're going to see maybe 5 to 8 people coming in and trying out. And if you take that to the corporate space, like think about if any of your audience today was in maybe tech or some sort of industry and you had 5 to 8 people coming in on a weekly basis coming to take your spot, right? Your job. Like how do you perceive that, right? How do you deal with that on a weekly basis?
By the way, I hear it's way more than 5 to 8 if you're playing on the New York Jets right now.
Fair enough.
Yeah. So think about like how that, the mental impacts behind that, right? And so it was very, very challenging for a lot of different reasons, just dealing with the process of coming back. I mean, when you're in the training room and coaches come by and say, hey, how's your knee going? You think you're going to be ready for OTAs, for camp? It's more so kind of like a passive aggressive way of saying, we need you back on the field or else type of thing, right? If you're not one of the guys that's, essentially the top 20 on the roster that's getting paid, multi-million dollars, I mean, you're susceptible to getting cut at any week, right?
Yep.
So that's a little microcosm of, the stress, factors and things that go into play with the mental challenges of the NFL and what I had to deal with, when it came to my injury.
Gotcha. Yeah, I mean that's got to be tough, right? Just the stress of potentially seeing your replacement walk in the front door, right? So now you have your injury, you rebound, you come back for the second season, and then you end up getting re-injured and decide that it's time to hang up the cleats and leave the NFL.
Yeah. It was one of the most challenging decisions that I think that I have had to make because of what it took to get there, right?
Mm-hmm.
I mentioned on the onset of the podcast, I started off at Division II, gave up my scholarship to walk on to the University of Maryland, had to battle from the bottom of the depth chart up, and just the hurdles and the challenges that you had to overcome to get to that level. It was definitely a huge, a very, very sour taste in my mouth. But for me, I think that the saying goes, when shit hits the fan, and I apologize, when things hit the fan, go back to your level of your training. Right?
Mm-hmm.
That's how you overcome adversity. If you ever look at a person and want to judge how they can handle adversity, we'll put them in a boiling pot, right? We'll see if it gets soft or it gets hard, right? So I think for me, I just wanted to take all of the skills and the soft skills that I've just cultivated as a person and really translate that into the world of real estate, which is what we try to do on a day-to-day basis.
Love that. Yeah, I love that quote too. I don't know if it's a SEAL thing or just a military thing, right? People rarely rise to the occasion, but they always fall back to the level they're training, 100%. Right? And I think it very interesting that you brought that up. So you leave the NFL, then you transition to PE for a while.
Yeah.
Where'd you end up? And of all the things you could have done,
so you leave the thing that 1,000th of 1% of people on earth are qualified to do, and you say, let's go do the next hardest thing.
Yes. So tell us a little bit about it. Why you thought that was right for you?
Yeah. Good question. So the reason I always wanted to, when I transitioned into the world of real estate, like everyone read Rich Dad, Poor Dad and other books that are a part of the industry, I always knew that I wanted to, build a company, right, that's focused on real estate. But the challenge was that I did not have any real estate background. And again, as I mentioned, I wanted to essentially model or replicate the success that allowed me to get to the NFL through real estate. So I found that if you're able to latch yourself onto or be a part of something that is where you want to be, that is where you want to spend a lot of your time. So I wanted to learn from people who are doing things at a high level, which is to me synonymous to watching film, right? Of just being around and replicating what they're doing, learning what they're doing so I can apply that into my own business. So I decided to, network and try to find someone that would be willing to take a chance on me to add value to their firm, move around to different firms that would allow me to create that core foundation of knowledge through hands-on experience that would allow me to replicate some of the successes that they had into my own business. So that's why I chose to go work for someone else before jumping out full time and growing our own firm.
Love it.
Man, that is incredible. So, I mean, obviously you work to learn before you work to earn, but also you earn good money too in the P&E, sector. So that's awesome. Got in, on the asset management sort of route. What was it that kind of triggered you and piqued you to go, okay, now is the time, right? I need to transition. I need to go build. I need to go and drive forward on my own adventure. How did that process and that transition look? And how did you know this is the time that I need to go out on my own?
Yeah. So I think for me, it was more so around the 10,000 hour rule, right?
Sure.
Spending a lot of time immersing yourself in an industry to where you feel like you're good at something, right? You have something cooking. I think also, simultaneously part of that too is just the confidence aspect, because there are going to be times where you may not truly be fully ready, I think, in your head, but you have to particularly in this space, when we talk about private equity and raising capital and doing deals and essentially being the leader, the operator, you have to have that level of confidence to understand that you will figure it out at some point, right? Or you will, as long as you fail forward, you are in the right direction.
Right.
And so that's what I just hung my hat on is, I think I have enough knowledge to be dangerous, right? But I also have the confidence to know that I'll figure it out as I go at the same time.
Love that, man.
I think there's an incredible amount of awareness in that thought process, right? I mean, there's a lot of people that want to do something and they're going to learn and they're going to learn more and they're always going to learn, and then they never take the step to actually go do it, right? And what I love about what Yannik is saying here is, like, he focused on the 10,000 hours. He learned just enough and kind of layered in that confidence and the fact that he knows he's been successful doing things twice before, right? And he can go do that. So I think that leap of confidence and faith right there, Yannik, is awesome, man. Good for you. So you make the leap full time into multifamily, and of all the things that you can do inside of multifamily, senior, conventional, right? You end up in the affordable space. So what was it about the affordable market that appealed to you and kind of served to be your calling in what you're going to do for the foreseeable future?
Yeah. So we started off doing some acquisition deals. Did 3 deals in total, 69 units.
Nice.
And then we've made the decision to also, because of the changes in the market and the Fed increasing interest rates and that completely, having an effect on deals being able to pencil, particularly in the acquisition space. But I think across the board, right? But to your point, in the affordable housing arena, I think now is a fantastic time to focus on affordable housing for many different reasons. I think one of it is just obviously the demand, right? I don't think that the U.S. has what it needs or has the resources out there or is willing to really sit down and focus on how to put a plan together to solve the affordable housing crisis. I think that the factors that are against the industry are insurmountable. When you take a look at the construction costs, the labor costs, the insurance costs, and now we have the only thing that the Fed can use, which is interest rates, becoming a challenge. I think now is a great time to figure out how to add value in that space. When it comes to affordable housing, when we say affordable housing, we say uppercase A affordable housing. So LIHTC, tax credit affordable housing. We're working on a 65 unit site right now where if we are approved through the competitive round through the 9% affordable tax credits, we're able to leverage state approved equity sources, which is typically around 70% or so of the total development costs to fund their projects. And the way that these deals work essentially is that you have your total development cost of X. And let's say you're doing a 9% round, which is a competitive round. Well, the state will approve your development to be funded by maybe a Goldman Sachs housing equity fund or an Amazon maybe equity fund or some sort of syndicator that essentially pools these resources from different entities who want to allocate capital to mission-driven projects. They will invest in your project, and you have to essentially go out there and find other sources to fill the gap. Whether that means a grant from the city or a grant from a nonprofit or different sources, essentially, that would allow you to fill that capital stack. A lot of times when you take a look at affordable housing transactions, think about it from a lasagna of sources. You have your equity, then you may have some housing trust funds there, then you might have some another soft subordinate loan as well. Then you might have a grant from a nonprofit, and then you might have the city may be doing a seller take back loan if you're buying the land from the city. So there's a layer of sources that will meet your uses for you to go out there and actually execute on that development project.
Wow.
And most of the time, actually all the time, developers are doing this for profit, right? They're also doing it for mission-driven causes, right? But the money is not made necessarily through the cash flow, it's made through the developer fee. So your developer fee might be 10 to 15%, depending on the state's requirements on what you can use to calculate that developer fee. You may be, total developer fee might be $2 million on a $20 million project, right? So I say that to say, I think affordable housing is a fantastic route for people who are looking to get into the world of development, because the money can be there if you have a good opportunity, but then also you're able to solve a problem that I think the government has no chance at solving at this point.
Yeah, I mean, I couldn't agree. One, thank you for the breakdown, because there's a lot of questions that I would just answered while I was listening to you, which is amazing. And we talk about this all the time. Common sense investment strategies. What is the most obvious and most difficult to solve need, right? We talk about all sorts of different asset classes. We try to future cast and all those things. Affordable housing is the most in your face problem to solve in the American economy and in the American society right now, and so these types of strategies and these types of initiatives take care of the biggest problem that I think Americans as a society face right now, which is incredible. Just out of curiosity, so what is the actual, you say you have to go through the approval stages. I'm just curious, what does that look like? What is the city or whomever is the governing body? What are they looking for as far as you as an investor or developer? Like, what does that process sort of look like?
Yeah, so it all starts with your state's qualified allocation plan. So your state is generally going to have that document, and that document is essentially going to be your Bible for affordable housing, right? And that is the document that you have to literally comb through line by line, paragraph by paragraph, because the state is going to have a federal level mandate on how to qualify for the program, but then they're also going to have a state level requirements to be competitive, because the projects are essentially maybe, the projects are essentially a lot of investors competing for a limited amount of tax credit subsidy sources. So it's very, very competitive. And the way that you win these sources is essentially by scoring the highest amount of points based off of a particular scoring factor within that qualified allocation plan.
Gotcha.
So that is where you start to really get into the weeds behind, okay, they want to see, a lot of units may be skewed to your 30% area median income, right? Mm-hmm. Or they may want to see that your project has a specific, tenant services component to it that is a reflection of the demographic that's in your project. And that can be maybe, persons that are homeless, maybe with disabilities, or, just your ordinary family project, right, with children. So it really comes down to you diving into that qualified allocation plan and really combing through it, because these transactions are extremely complex. And it's not like your ordinary market acquisition where you see property, you buy the property, right? You make sure it pencils, the numbers, cash flow, let's do the deal. In the affordable space, it's more so, well, how does my project fit within the scoring criteria? Because if you don't win, then there is an application fee that's associated with that, and obviously time, and also money, because you're not able to get any revenue on that project.
Sure.
It's very, very complicated.
What are some of the example criteria that they score on, if you don't mind?
Yeah, so there's different levels to the scoring criteria. Some may have more points than others. So they may be looking for developer capacity from a net worth and liquidity perspective. They may be looking at an income targeting perspective. So from the federal standards, affordability starts at 80% AMI, right? And then it works all the way downwards, down to scale, maybe down to like 30%, which is considered deeply affordable. So depending on how skewed your building is between 80% AMI to 30% AMI, because when you have these rent brackets on your property, right? So say, for example, you're doing a 100 unit property and, 50% of your property is 80%, just for good numbers, and 50% is 30% AMI. Well, every year HUD releases LIHTC income limits that require you to keep that rent at that particular amount. So it's not like a market rate transaction where you can just jack up the rents because the person next door is doing it. You have to literally follow HUD standards. So that's why these projects typically become very, very challenging to pencil, because as you guys already know, you start with your rents and you work down, right? And if you aren't able to get to your NOI, then this deal isn't going to work out, right? Especially when you talk about interest rates and how that affects debt. Well, if my rent is the same and rates have gone up by 5%, how do these projects pencil? So to answer your question, there's a lot of different scoring requirements and criteria that is required for you to score a certain amount on a project. But it's even more challenging because the rent is reduced on an annual basis.
Yeah. So I've been kind of thinking about this question here for the last couple minutes as you've been talking. We've covered on pretty much every show the financial squeeze happening in multifamily this year, right? We've seen taxes pretty much get maximized in every way, right? Insurance has gone through the roof, and interest rates have definitely put a hamper on things. And then you have a lot of this, Class A incoming supply that has put pressure on rent growth, and in some cases, caused it to go even negative. That's made it difficult for the conventional operators that we know and have interviewed to make money and deliver on their investor expectations and overall NOI, et cetera, et cetera. And conventional owners and operators, they have the ability to adjust the market rent, right? Affordable housing doesn't have that. So how have you and the rest of the affordable operators that and network with, how are you navigating that? Because I feel like it's just this pinch, right? You're maxed out at the top and your expense ratio is growing, and that can't be comfortable and can't be easy to do.
Yeah. So the challenge, I think the biggest challenges for the industry is definitely the debt aspect. I mean, you have insurance costs, et cetera. But a lot of times for you to make those deals pencil, it comes into play, well, what soft debt sources are available, right? Because if you take a look at a total development cost and you say, well, maybe, let's say just for good numbers, 75% is going to be refinanced at a particular value. Well, if I'm able to find soft debt, maybe through different grants, et cetera, or just subordinate loans at maybe 0% interest to cut down on that debt amount that you're paying some sort of interest on, then these projects aren't going to work, right? And it comes back to what I said at the beginning of the show of the government needing to provide the resources to developers via the soft debt to allow us to bring that total debt threshold down for these deals to make sense and ultimately, have some sort of debt service coverage ratio, right?
Yeah.
Because if your debt is increased, well, the only way to decrease that is through maybe your soft debt to bring that stack down, or just subordinate loans at maybe 0% or some sort of favorable structure, whether you're kicking the payment can down the road when the project has a little bit more cash flow to pay for that, right? So it's very complex and challenging in today's industry. So that's how developers have been approaching that.
Wow.
Well, so it sounds like, and that's a great explanation. It sounds like when you're going into, phase one of the underwriting process for a potential deal, you're not quite sure what that stack is going to look like. So how do you, even though this is more of the money's made on the developer fee, you've still got, there's still debt in the stack. I'm sure Amazon or Goldman or whomever is expecting a return. Without knowing what that stack's going to look like, how are you approaching underwriting for the actual deal itself and getting it through the different phases?
Yeah, good question. So on the equity side, let's say for an Amazon investor, et cetera, they're investing for the tax benefits. So
that makes sense.
There's an IRR and the tax benefits, right? So let's say my project can support, for good numbers, $1 million in equity, right? That's what the state is willing to give to you for your project. That $1 million. So let me start back over. So let's say that you're doing a $10 million project, right? And you need, your state is going to allow, $7 million of equity.
Okay.
Your tax credit investor is going to purchase that $7 million equity check at maybe 90 cents on the dollar, right? Okay. So they're not paying $7 million to get into your deal. They're paying whatever 90% of the million is.
0.3 or whatever. Right.
Yeah, right. So there's a spread on that, right? And when they invest in your project, it's a federal tax credit. So they're getting the tax write-off for the $7 million check.
Right. Interesting.
Right. So
they get to write the whole thing off?
Correct. Yeah, as long as the property stays in compliance throughout the 15-year compliant period, they're getting that $7 million equity check written off.
It makes sense that that's really what they're investing for. So that's how they're kind of underwriting their own returns is, what kind of tax savings are we going to get? So, that makes a lot more sense.
So are you paying them a return on top of the federal tax credit they're getting by giving you the equity?
So their sole interest is primarily getting the tax write-off, right? Because these deals typically don't cash flow very well. It's not like a market rate transaction. So the IRR has to make sense on the tax benefits that they're getting on the property as well as the depreciation from the property. Right. So these deals typically get penciled out a 99.99 versus a 0.00 or 0.01001 split between GP and LP. So they're getting all the benefits, and then your sponsor, your GP, is getting the developer fee.
Right.
So your tax credit investor, it has to make sense from a tax perspective, right? And to invest in your deal. A lot of times you just have to. It's a rule in the industry. You're always looking for money, right? You're always looking for some sort of subsidy or grant program, because a lot of the time they have limited amount of funds, right? And those funds can be depleted at any given time, depending on the demand for it.
Right.
So it's similar to the market rate side of things, right? You need your equity for the most part before the deal, and you're always trying to go out there and be in tune with the funds that are available.
Right.
So when when it's time to actually apply for the tax credits on a competitive basis, where that subsidy or those gaps are going to be filled from.
Right. And that makes perfect sense. I appreciate the breakdown. So really the theoretically it's we already know what the equity return, what they're looking for. They're looking for the tax credit, right? So we don't have to go and figure out, is this a saleable deal, or are we going to get a 2-time equity multiple and cash on cash, right? Like that's already there. And so your job is to keep up from an educational standpoint with what are the other soft debt sources that are available to us right now, so that we know we need to fill that gap. Here's what the deal needs to look like to make sure that it's not essentially losing money and we're able to pay our bills, but you're not necessarily having to worry about, call your equity or LPs. You're not really worried about their return. They know what they're getting and they know what they're in it for. So it's a different way of underwriting, but it's not necessarily more complex. It's just a different approach. And that makes perfect sense. I appreciate the explanation.
Yeah, that's great. Yeah. So a question for you on the debt side. So we've talked, we had a finance broker on the show 20 episodes or so ago, talking about agency and bridge and bank and various other types of funding sources. And I think there's HUD programs out there available through Fannie and Freddie, but do those programs apply for development, or are you literally having to go find kind of a bridge type product, and then refi onto a Fannie or Freddie HUD program once you're fully developed?
Yeah. So there are programs out there that are available from a bridge to your HUD loan, your 40-year loan, low interest loan out there as well, and that certainly helps a lot when it comes to the cash flow, right? Because a 30-year amortized loan versus a 40-year loan is significantly different from a cash flow perspective.
Yeah.
So a lot of developers have found HUD loans to be super attractive for that specific reason, right? Because of the low interest and because of the maybe some incentives that you're able to get because of the mission-driven impact that HUD has, right? And similar to market rate, if you're doing a Freddie Mac loan, there's a certain amount of basis points that would be, reduced from your interest rate because of the affordability component to it. So absolutely, developers, love those programs, those mortgage options as well.
What kind of rates are you seeing on those types of products lately?
Yeah, so what I'm hearing is around 6 to 7% is what I'm hearing right now. And of course, that's very, very challenging in a space or in a market where it seems like everything is going up, right? I mentioned insurance. It's crazy, particularly in these coastal markets. Your construction costs are going up. Your labor costs are going up. Land costs are going up as well. So right now, I think is a very challenging time to put these deals together. And it just goes back to, my previous point of always looking for some sort of subordinate financing of some sort of way to cut that capital stack down so you can have a softer total debt cost
right
for your project.
Yeah, and obviously that's that's got to be a priority for our governing bodies, is to provide those resources. And when we look at normal, let's say we're looking at normal Class B deals here in the North Texas area, we usually have a pretty good handle on what the opportunity is. We try to forecast rent growth based on units coming online, the amount of Class A we're going to be dealing with or competing with, that's new construction and things like that. And that helps drive our forecast for our models. I'm sure you do something similar in the areas that you're investing in, that you're working on your projects. And just how big do you believe in the markets that you're looking in, specifically the Maryland area? How big is the opportunity to provide more affordable housing? I mean, as far as people like you that are doing an incredible mission-driven work, how big is that gap to fill, do you think?
Yeah, I think across the country there's an affordable housing crisis. I think, I just read something the other day saying New York is like the most expensive in the country or something like that. Mm-hmm. There's another article floating around saying that the level of affordability is at the worst it's ever been in U.S. history. Particularly in Maryland, I was at a conference, an affordable housing conference a few weeks ago, and they were saying, well, Maryland needs 70,000 units, when we only have about 1,000 in the pipeline right now. Right? So I think, I'm always looking at opportunities to do two things, right? And that's income and impact. And I think that if you are able to find these sites, find these opportunities, there's just such a pipeline of demand that I think is, for the foreseeable future is never going to be filled unless there's a serious huddle by the governing entities to really solve the affordable housing crisis. And a lot of that is through incentives, right? I mean, incentives, if you think about it from even the energy market right now and electric vehicles, well, incentives drive that investment outcome, right? Or that mission-driven outcome. It's just a fact. So I think that government really just has to incentivize developers through tax breaks a lot of times, right, to actually put their capital to work to do the good that the government wants to see.
Yeah. I'm not a very political person, but I think that what Yannik just said is, it's very interesting, right? Because we're having a bunch of people decide on affordable housing decisions, many of whom have made a lot of money in real estate, right? And we're basically asking them to do the opposite of what made their wealth, right? And I think that's a very, very interesting dichotomy and a very interesting conversation that we can have probably a much longer podcast about. But like I was sat through a presentation by the head of the NMHC a couple of weeks ago. The NMHC is a very important council in the country, kind of advocating for multifamily. And she gave a very interesting statistic. She said that of all the land in the country that's dedicated to housing, 75% of it is zoned for single family.
Really?
Yes. So 75% of all the land in the country that's zoned for housing is zoned for single family, which gives us 1 out of every 4 pieces of land available for multifamily. And as Yannik is telling us about, this market, I'm sitting here wondering, like, how much of that 25% is available and frankly affordable to build affordable housing on. Right. So, Yannik, when Brian and Nick and I and some of my other partners, we have not done any sort of development yet, but almost weekly we see a multifamily lot available for sale, and we kind of romanticize about developing one day. Are you chasing those same lots, or are there certain subsets of lots and land available for affordable within that space?
Yeah. So we're chasing the same lots, whether it's a vacant parcel, maybe a 10,000 square foot parcel, or even a historic building, right? Because you can also get an acquisition credit on the building, a 4% acquisition credit if you're doing some sort of historic renovation. Let's say you're taking a factory and making it into a 100-unit, affordable housing project. You'd be able to get an acquisition credit of 4% on that particular, on just a building basis itself, right? Separating out the land basis, right? You'll be able to get a tax credit on that. I think that, to your point, right? I mean, there's a lot that has to go into the political space to rezone or allow for specific developments, particularly multifamily on those parcels, because, I mean, you made a great point, right? 25%. I mean, how many people are willing to sell, and how many of that can actually be used or make sense to do a multifamily project, right? So I think, to answer your question, we're looking at some of those same lots, those industrial buildings, maybe a historic site that used to be a factory, to do some sort of historic renovation as well, which you can also get historic tax credits on those buildings as well. Pretty much an array of different potential site opportunities that can fit within the LIHTC bubble.
Let me double tap into that for just a second while this is hot. So let's flip the table here for a second. So if I'm a seller and I have a piece of land, and you and Brian, right? Brian's on the conventional side, you're on the affordable side. You're both bidding on the same piece of land, right? I see a challenge there for you, right? Because Brian, who is going to build conventional housing and may have more flexibility on rent growth and blanket insurance policies and all kinds of stuff, like, is there something in it for the seller to sell to you instead of Brian? And by the way, I don't want you two competing with each other because we're on the same team, right? But I'm just using that as an example. Is there something? Is there something in it for the seller to say, okay, well, I may not get the top dollar from Yannik because he's going to build affordable housing, but there's something in it for me on the back end?
Yeah, definitely. I think there's a couple different ways that you can slice the pie, right? I mean, you made a good point, between, I think, what you were alluding to, which is price and terms, right? I mean, he might be offering a different price. I might be offering a higher price because I have to essentially sit to get the approvals, right, through the planning department or just through the competitive scoring process, or if you're doing a 4% transaction, which is bonds, just going through that process to actually get approved before I even stick a shovel into the ground.
Right.
And I think there could be opportunities to, from a seller perspective, to partner up with that developer and participate in that developer fee, or maybe take a lower price and just sell it to Brian and get his money and ride off into the sunset, right? So I think there's ways to look at it.
So I was thinking, like, so buying from the developer and actually making them a partner in a deal is always a creative way to make a win-win for everyone. This question was circling around in my head as you mentioned, factory renovations and things like that. I oftentimes think some of the most obvious answers are hiding in plain sight. If you guys given thought or explored the idea of, what we think we might be on the precipice of in the commercial space, and what a government driven initiative to convert much lower occupied commercial buildings into affordable housing. Are you guys keeping your pulse on that kind of dynamic?
Yeah, 100%. I think because there is such a need for affordable housing, I think there's some developing incentives out there, but also incentives that are in the program to capture or to get additional equity for the basis of the building itself, right? To make those projects pencil. I think the common theme in today's conversation, it really just comes down to subsidy and those incentives, right?
Yep.
Marrying the two to make the development make sense.
Yep. 100%. And this is like, Matt, I don't want to get political here, but right, the commercial, you don't want to call it collapse, but the theoretical decay of the commercial building space could potentially be the driving force behind what could be a very great solution to the affordable housing crisis that also plays really well on the political stage.
Yeah,
you know what I mean?
Agree.
It's the same people you're talking about trying to make a whole lot of money in real estate, and then trying to make policies that actually create affordable housing and don't pay investors billions of dollars a year. There are a lot of investors with a lot of money tied up in commercial space that aren't making a dime right now.
Yeah.
And so those two ideologies could marry a little bit and actually do some good. Once in a while.
I mean, I think the same thing. There's just so many ways. You've talked about this a number of times, right? One of the things we love about this business is the intellectual challenges that we constantly have to navigate and overcome and think through in order to find opportunities. And there's got to be a different way than just, the what seems to be like a very heavy process that Yannik has painted here for us today, with the capital stack and the zoning and all that sort of, just the legislation.
Like, why is it so much easier to go buy a $35 million Class A building than it is to go build 100 affordable units? Why do you have to jump through so many more hoops?
I hear you, man. I mean, there's probably there's less glamour in it, right? I mean, there's definitely more of a cause, and that's one of the things that I've picked up from, Yannik said, income and impact, right? And I love that. But I think it's greed and glamour is what it boils down to.
Yeah.
Right. I mean, I have not seen, of all the Facebook groups that you and I are in and all the newsletters that we're on, masterminds, I've not seen anyone really celebrated for what they're doing in the affordable space, and that's something, Yannik, you have our commitment, man. That's something we're going to do more of.
Yeah.
I mean, this has been eye-opening for me. Question for you, and I'm sad to even have to ask this question, but we're in a very interesting point in society right now. With everything that, with all the red tape and the hoops and the structuring that you need to do, on top of the legislation and the government assistance that I think needs to be brought to the forefront for affordable housing, is there a NIMBY component, right? Still out there?
Absolutely, man. NIMBY is interesting, right? Because everyone, I think if you're a good person, right? If you could sit down in your bed at night and lay your head, if you're a good person, you want affordable housing, right? You want people to have a place to live. Nobody wants to see someone on the street, having no place to live, right? I think if you're a person that has a heart, you want to see affordable housing. But the thing is, you don't want to see affordable housing in your neighborhood, right?
Mm-hmm.
Because a lot of people they have this misconception that affordable housing is Section 8 voucher housing, where people are going to come into my community and destroy my community, or bring a bad taste, or potentially decrease the property values.
Right.
When in actuality, nothing can be further from the truth, right? Because affordable can be the doctor the affordable can be the teacher that your kids go to, or the fire department that's coming out to check on your smoke detector because it's going off, right? I think there's a huge misconception to affordable housing, and a lot of times the standards in affordable housing is much higher from a build perspective and an aesthetic perspective than a market rate transaction, because of the stigma and the desire to build a sustainable and environmentally friendly building, right? That looks great. So a lot of times in today's world, if you take a look at what the government did back in maybe the 60s, or, around that time, you can tell what a project looks like, right? Because the government is not good at providing housing, right? That's why they created this act back in the late 80s to allow private investors who have creativity, who have ideas, who have the wherewithal and the capacity to do these projects in a market-driven way, or a market rate way. So in today's world, you may not recognize that new building that was built, where you go to your Trader Joe's, right? That might have some affordability component to it.
Sure.
Right? But I think when people hear affordable housing, they're up in arms because they don't want those people in my neighborhood, right?
Yeah.
I think there's a lot of there's a psychology that comes with that, and the need to educate people on the fact that an 80% AMI, that's someone who you probably, your close friend, right? That's struggling, that does not have the wherewithal to pay their rent. Well, they could be living in a nice building that has, services like maybe financial education or something like that will help them to live a better life. So I think, to your point, the whole NIMBY movement, I think, is somewhat misinformed, and really needs to think about the societal impacts that can be facilitated by having that mixed income, or having some sort of affordability component to your building, but then also market rate inside of your building as well. Because, we could only grow as a society if we have everyone living together, right? That allows us to really engage in discourse in a way that allows us to understand each other as people. But then also it's good for society, right? To have a diverse population, right? Studies have shown it provides more benefit to society, or to your ecosystem as a whole. Right?
Yeah.
I think that, NIMBY just needs to be reinformed.
Yeah, agreed. I think we talk about the affordable housing crisis, but a lot of those, nothing's ever absolute, so I can't say everyone, but a lot of those people, a lot of the people that will end up living in your developments, right? They're going to turn those units into homes. Absolutely. Right? And there's a lot to be said for the societal impact long term of growing up in a house versus a home, right? You have your family unit, you're sitting down to dinner together, right? You're going to good schools, the whole thing. And I think that's kind of the long-term risk of not fixing this problem, right? Is how do how do we as a society look in 50 or 100 years where, the gestation and all the kids being brought up right now, right, don't have necessarily a home. I grew up in New York, right? So I used to see, Queensbridge housing projects all the time and Flushing housing projects all the time. And it's just different. It doesn't have to be that way anymore, right? We've come so far where it's not this kind of institutional feel, right? It can be different, and you're, to your point, you're actually adding value to the neighborhood over the course of time. It may not be evident right away, but nothing turns on a dime. And I think to your point too, I mean, even Section 8 gets a bad rap. I still have a core portfolio of Section 8 housing in my portfolio, and I buy them selectively in certain areas of the market, but I got to tell you, there is something that happens inside me when a single mom with 2 or 3 kids comes and looks at the property when they're coming from a real tough part of town, and you look up their address on spot crime and you're seeing the gunshots and the robberies and all kinds of stuff. And all of a sudden her and her young kids are living on a tree-lined street in a good neighborhood. Like, they appreciate it. They think about it as a second chance at life. Their kids are going to be safe. Their kids are going to be, well taken care of, and it's just merely meaningful for them. And some of them have been with me 5, 6, 7 years, right? They're great tenants. They're great residents. They're low maintenance. You fix the microwave every once in a while and make sure the smoke alarms and the GFCIs work, and they know what they have, and they don't want to jeopardize that. So I think there's absolutely a calling to this, right? And you got to think past the spreadsheets and the rent growth and all kinds of stuff, and realize that we're making a societal impact over the course of time. So, man, this conversation's kind of got my mind racing about this.
Yeah, absolutely, man. I think it's called the social determinants of health, right? Where you live determines your outcome, right? And it's synonymous with when people say, you're the microcosm of all the 5 people that you're around, right? I mean, that's just how things work. And I've also experienced some of the things that you've said as well within my core, legacy single family portfolio as well. Those Section 8 tenants can be some of the nicest people. As long as you take care of them like anyone else, I think this stigma is it's just got to be erased.
Love it. So, Yannik, we got to start wrapping up here. I want to be cognizant of your time. Tons of gems on this episode, man. And I mean, I learned a lot, and definitely refreshing to talk to you about this aspect of multifamily real estate. 2 things. Anything that you want to leave our listeners with from a guidance or market opportunity perspective? And then 2, how can people find you?
Yeah, I appreciate it. So I think from a market perspective, I think right now is an interesting time to invest in, multifamily or just commercial real estate. Obviously, the market is what it is. Interest rates, it is what it is. I think right now, we're focused on finding opportunities that are stable, that have some sort of historical strength of cash flow in our value add acquisitions. And on the affordable housing space, I mentioned there's no lack of affordability out there, right? So we're looking for sites that make sense, and partnering up with nonprofit entities and finding the subsidy to make the impact that we want to. I'm always happy to connect with people that are looking to get into real estate, frequently on LinkedIn. So look me up on LinkedIn. I'll accept the connection. And I appreciate you guys having me on the show.
Yeah. Likewise, brother. This is a blast, man. We'll definitely have to do it again soon. I'd love to dive even deeper. Yeah, send us some pictures and stuff as you get these developments going, and ribbon cutting ceremonies and all stuff. We'd love to put it attach it to the show notes of this episode, put it on the website, and boost you guys up on social, man. You're doing something that's very, very difficult and something that's kind of against the grain. So kudos to you, man. We got your back. We'd love to keep in touch. Absolutely.
I appreciate it. Thanks so much.
All righty, guys. That is episode 22 in the books. Make sure you check out One Maryland Real Estate Partners, also deepbluere.com. Connect with Yannik online, and then go to Toolware Studios, TORE Studios.com. Yannik, thank you again, man, and we appreciate it, guys. We'll see you next time.